Across the United States, a quiet transformation is happening inside America's biggest retail chains. From clothing stores to pharmacies to home improvement giants, a new strategy is taking hold. Companies are reducing staff, sometimes slowly, sometimes dramatically, cutting hours, eliminating positions, and restructuring entire departments. Shoppers walk into stores and immediately feel it. Fewer cashiers, fewer associates, fewer people to help, restock, or manage the growing demands of modern retail. Yet behind the scenes, something even more astonishing is happening. Their stock prices keep going up. Wall Street sees these cuts not as a warning sign, but as an opportunity. Lower labor costs, higher margins, lean operations, more automation. For investors, this is efficiency. For workers, it's a warning of what the future of retail might look like. Today, we count down the top 10 big retailers cutting workers, but their stock keeps going up, and uncover the deeper trend reshaping retail in 2025. 10. Kohl's has been struggling with declining in-store traffic and rising pressure from online competitors. In response, the company has reduced staff across sales floors, fitting rooms, and inventory teams. Customers report longer waits, fewer open registers, and fewer associates available to assist. But to investors, this leaner footprint signals stability, resulting in a slow but steady rise in stock value. Kohl's believes smaller teams and automated systems can keep stores running, even if the customer experience takes the hit. Walgreens. Walgreens is quietly restructuring locations across the country. Pharmacy technicians, front-end employees, and photo department workers have all faced cuts. Store teams that once operated with 8 to 10 people now sometimes run with half that number. While communities feel the impact, especially in towns where Walgreens is one of the only pharmacies available, shareholders interpret the cuts as financial discipline. Even as service declines, the stock keeps inching upward. It's a clear example of the retail paradox: lower service levels, higher investor confidence. Best Buy. Best Buy's transformation is well underway. With more purchases shifting online, the company is reducing in-store sales teams, warehouse labor, and specialty departments. Many stores now rely on a handful of employees to cover large sections, from home theater to appliances to gaming. But with fewer salaries to pay, Best Buy's balance sheet looks increasingly strong. Operational efficiency has become the core of its strategy, and Wall Street is rewarding the shift. Even with thinner teams, Best Buy's stock performance shows just how far efficiency culture has taken over retail. Macy's. The iconic department store has been on a long journey of downsizing, but 2025 brought a new wave of cuts. Entire floors operate with minimal staff. Distribution centers and warehouses have consolidated roles. Management positions in multiple regions have been eliminated. Yet despite all the cuts, Macy's financial forecasts have improved. Lower payroll expenses mean stronger quarterly earnings, and that's exactly what investors want to see. The company's stock has shown surprising resilience, even as the in-store experience becomes harder to maintain. CVS is reducing labor across its pharmacy counters, front store operations, and fulfillment centers. The company is investing heavily in automation, centralized dispensing, and self-checkout, systems that require far fewer employees than traditional store staffing. For customers, this means longer lines at pharmacies and fewer staff available for assistance. For investors, it means greater efficiency and higher margins. CVS has positioned itself as a healthcare retail hybrid, and that transition relies on automation replacing human workers. Home Depot. Home Depot may be booming in sales, but staffing is shrinking. Seasonal hiring has been reduced significantly. Departments like garden, lumber, and tool rental now operate with fewer associates covering larger areas. Automation and logistics investments mean the company can move products faster with fewer people. Because of this, Home Depot's stock continues performing strongly. Investors see the company as a model of operational efficiency, getting more done with less labor. But for employees, it means heavier workloads and fewer hands to share the pressure. Target's workforce reductions have rolled out quietly but consistently. Hours have been trimmed, departments consolidated, overnight stocking teams reduced, self-checkout expanded dramatically, replacing cashier roles that once filled entire front areas. The company claims these changes make operations streamlined and modern. Wall Street agrees, rewarding Target with rising stock prices as expenses go down. But in many stores, workers describe being stretched thinner than ever before. Amazon has cut tens of thousands of jobs across logistics, tech divisions, and corporate roles. The company's long-term vision is clear. Automation, robotics, and AI will replace a massive portion of its workforce. Fulfillment centers now use advanced systems to sort, move, and package goods. Stores like Amazon Fresh operate with minimal employees thanks to automation. Every cost-cutting wave is followed by a rise in Amazon stock, making it one of the clearest examples of investors rewarding labor reductions. Walmart. Walmart is in the middle of a huge transition. Self-checkout has reduced the need for cashiers. Regional management teams have been restructured. Backroom operations are increasingly automated. The company is also shifting towards smaller, more efficient staffing models, according to internal communications. Even with these cuts, Walmart's earnings remain strong, and the stock continues climbing. Investors see Walmart as a well-oiled machine, one that grows more efficient with each year. Dollar General takes the #1 spot because its entire business model revolves around extreme efficiency. Stores often operate with only 2 or 3 employees, responsible for stocking, cashing, cleaning, and security. Labor cuts have accelerated even as the company opens hundreds of new stores each year. Workers report handling multiple roles simultaneously, sometimes running entire stores alone during shifts. But low labor costs are exactly what keep Dollar General profitable. And investors love it, pushing the stock higher year after year. Dollar General's strategy reveals a harsh truth. In modern retail, the fewer the workers, the higher the profits. The pattern is clear. Across the retail landscape, companies are cutting workers faster than ever before. For employees, the workload grows. For customers, service declines. But for investors, the story is different. Lower costs, higher margins, stronger stock performance. This is the new reality shaping American retail. A future where automation replaces people, where efficiency comes before service, and where Wall Street rewards cost-cutting above all else. The question is no longer if this trend will continue, but how far it will go.